So kind of switch gears a little bit to anybody who owns a business. And so this could be any business. This could be a full-time business. This could be a part-time business. Anything that, so the first thing is, this is a C corporation. So this is anybody who does not have a sole proprietor or a farm or rental property. So this is a full-blown C corporation. The tax rate used to be tiered, and at the low end of the scale, a corporate actually paid less tax than an individual on the low end of the scale. As the scale went up, a corporation paid a higher tax rate than an individual. They came through and made this just a flat 21% rate on corporations. And it's interesting because when you do the math, for this rate to be equitable to the corporation needs to make about $98,000 a year for the math to work out, where their effective rate was 21% anyway. For a corporation making $1 million, they're loving this rate. For a corporation that was making $50,000, you don't like this rate anymore because that's higher than what you were paying before. So inside a business, you could exchange properties. We'll take a farm, for instance. So a farmer would buy a tractor, use it for a couple years. He'd trade that tractor in on a new tractor. He'd be able to do a like-kind exchange on that tractor and not have to pay any capital gains tax or anything on it as he buys a new one or sells it and gets another one. They've done away with this provision except for with real property. So a house, commercial property, apartment building, anything somebody can own can still do an exchange, a tax-free exchange for one property to another. But real property is the only thing you can do this for anymore. So used to, we would use this a lot. I mean, you're selling a truck, getting a new truck, selling a tractor, a combine, whatever the case may be. We would use this a lot to be able to do that exchange and not have it be a taxable event. So we've had to rethink a little bit, and clients have had to rethink a little bit as to how do I do that transaction? So am I getting the new tractor for a tax purpose, or am I getting the new tractor because I actually need one? So it's interesting to see as this is being applied that if you're exchanging real estate, you can still do it. Another provision inside of a business is when you buy an asset, you depreciate that asset. You kind of depreciate it now because you get 100% bonus depreciation in the year you put it into service. So you buy a new computer for $1,000, in essence, you're gonna get a $1,000 tax return or $1,000 deduction on your tax return. This one is interesting because I threw this one in here just because this is a large corporation thing here. So I live in Indianapolis. So if my company happened to have a suite at Lucas Oil Stadium, which I don't, but if I did, I would no longer be able to deduct the cost of my suite at Lucas Oil Stadium. Now, this one, there's not a whole lot of people that are gonna be really upset that somebody can't deduct their suite at the Colts games anymore, but for large corporations that spend a lot of money in this area, it will have an impact on what they do. There's just some provisions on net operating loss. Okay, so on the business side, this right here, those 3 words, okay, there's 80 words. Those 3 words right there are going to be a game changer on your tax return. And here's why. So qualified business income is brand new. Somebody somewhere came up with this calculation. So pass-through entities, sole proprietor, an S corporation, a farm, if you own rental property, you can get potentially up to a 20% deduction of your income. So real simple example. So you work a full-time job. You're getting a W-2 from that job. On the side, you have a lawn mowing business that you make $10,000 doing. With this provision right here, you would only pay tax Now, it's a lot harder than this, so this would be really simple. You would pay tax on $8,000 of that $10,000. So you'd get a 20% deduction of the qualified business income. So it's not going to touch your W-2 that you earn, but potentially you could get this deduction. And so if you expand that, and so now I make $200,000, you'd pay tax on $160,000. You get a $40,000 deduction from your income based on this. Now, there's a lot of caveats with this one. One of the caveats is there's an income limitation. $157,500 for single, $315,000 for married. So if your income gets up into a higher level, more things come into play as to how much of a deduction you can get. Second caveat is depending on the type of business that you're in, there are qualifications as to whether or not you get this and how much you get it. So there's 9 industries that the IRS has picked on. If you're a doctor in the health profession, if you're a lawyer, if you're an accountant, actuarial, performing arts, consulting, athletics, so if you're a professional athlete, financial services, which are the guys in the back, and brokerage services. So the IRS has broken out those industries and said, okay, our rules are going to be a little bit different for those guys. Now, I will pick on one industry that's not up there because they have a better lobby than I do. That's real estate agents. So real estate agents are not on this list. Okay. Here's where it comes into play. Calculating the deduction. And I have my man screaming here because it is... I would need a whiteboard and a marker to draw you this diagram that's like this big that describes how to do this. Now, also, the thing about this deduction is if you're in this situation, there are opportunities to do some really creative things with a tax return. But it takes some planning to do it. So, take an example here of, I'm a CPA, say my wife was a real estate agent, okay? We've been married 26 years. We filed a joint tax return for 26 years, okay? I am in one of those 9 industries that would not be able to take this deduction. My wife is a real estate agent. She's not in one of those 9 industries. So in essence, she could take it. Now, hypothetically, say that our income is more than $315,000 combined. Another caveat, there's going to be issues on to whether or not we can take the deduction. We've been playing around for months with this of filing a separate tax return for husband and wife and playing the income against each other, that if the wife is in a non-prohibited industry, the husband is, together they make too much money to benefit from this, but maybe the wife individually is below, for this calculation as a single person, she makes below $157,000. On her half of the income, you could take some sort of a benefit for this deduction. So it opens up huge amounts of possibilities, but it also opens up a lot of planning that has to happen to be able to make it happen at this level. So on the personal side, the changes are going to affect everybody. Some of them will be more dramatic than others. It's going to be very interesting this year because with the changes, I mean, it's kind of, until we actually start to file tax returns and kind of see how things play out, it's going to be interesting because they've lowered the tax rates, but anybody who works a W-2 job, back in like February, March timeframe, they also lowered how much was being deducted out of your paycheck. So if you go back to that point in time, you're going to see that your paycheck changed slightly because they changed the amount of withholding based on these new numbers. So somebody's thinking, oh, my taxes, I'm gonna get a bigger refund this year because my tax rate is lower. Well, maybe not, because you got part of that money back in these little bitty chunks over the last 8 months of the year. For a retired person who's getting Social Security, retirement, and investments, chances are their tax return is not gonna change a whole lot. But working people, business people, you have kids in college, your tax return is gonna change a lot.